Welcome. In today's video, I'm going to show you guys how to calculate the net operating income of an investment property. For context, my name is Daniel Kwache with Scottfield Finance, and we partner with entrepreneurial and institutional real estate investors to help them purchase, refinance, rehab, and develop real estate. So jumping into our spreadsheet here, you'll notice that we have the properties rent roll. So for example, we're going to be calculating the NOI on a 10-unit investment property. So as you guys can see here, we have our annual income for this investment property, which is going to be $240,000. Now we'll go ahead and start calculating our NOI. So you'll see here we have our potential gross income for the property, which is going to be $240,000. The next step to calculating the NOI is we're going to go ahead and back out our vacancy rate. All right, so in theory, we would want to purchase an investment property and have it be 100% occupied 100% of the time. Practically speaking, that's not how it's going to work. You are going to have some vacancy rates where occasionally you'll have tenants who are not occupying the apartments. So in order for us to calculate our vacancy rate, we're going to take that $240,000 and we're going to multiply by our 5%. So what we'll do is we'll take the $240,000 and we're going to assume a vacancy rate of 5%. Now, depending on your local market and how you guys underwrite your deals, you can use a vacancy rate of 5%, you can use a vacancy rate of 3%, completely up to you. You know, some of the industry standard is going to be anywhere from 3 to 5%. So we'll go ahead and back out our vacancy rate of 5%. And once we've done that, we're going to go ahead and subtract that from our potential gross income, and that's going to bring us to our effective gross income. All right, so we now have the effective gross income of the property, assuming a vacancy rate of 5%. And now that we have the effective gross income of the property, we're going to go ahead and subtract all of the expenses that's associated with the property. All right, so for this example, I'm just going to go ahead and make up some numbers. So we have taxes on the property, which is going to be about $20,000 for the entire year, right? So we're calculating our NOI and we're going to be using our annual numbers. So our property tax is going to be $20,000 for the entire year. Our water and sewer is going to be, let's say, $15,000 for the entire year. We have the insurance that we're going to be paying on the property. That's going to be $8,400 for the entire year. We have our heating and gas, which is going to be $12,000 for the entire year. Next, we have our property management fee, and we're going to assume that this property management fee is going to be 5% of the effective gross income. So what we'll do is we'll take the effective gross income, we'll multiply that by 5%. And now that brings us to $11,400 for our property management fee. Next, we're going to back out our common area fee or our common area expenses. That's going to be $3,600. Our payroll is going to be $2,400, and then any maintenance fees associated with the property, right? So that's going to be our annual maintenance fees associated with the property. So we'll go ahead and say $3,000, and any legal fees that's associated with the property, we'll go ahead and back that out. So let's say we're spending $3,000 on legal fees for the property. And what we'll do next is we're going to go ahead and total all of our expenses. So once we've done that, you'll notice that we have our total expenses of the property to be $78,000, and I'm just going to go ahead and format these cells. All right, so you'll notice here all of our expenses have been added up and we have our total expenses of $78,000. Now, in order for us to arrive at the net operating income, what we're going to do is we're going to go ahead and take our effective gross income, and then we're going to go ahead and subtract the total expenses. And you'll notice that we now have an NOI of $149,000. All right, so that's essentially how you're going to calculate the NOI. You'll just go ahead and again, start with your potential gross income. You'll subtract your vacancy rates, right? That's going to bring you to your effective gross income. Once you get to your effective gross income, you'll subtract all of the expenses associated with the property, and that now brings you to your NOI for the property. All right, so why is the NOI important? The NOI is going to be the main driver of how we're going to evaluate this property, right? So let's say this property, depending on the local market or depending on your local market, let's say the assets in your local market have a cap rate of, let's say, 5%. And I'll give you guys a couple scenarios. So we'll assume a cap rate of 5%. We'll also assume a cap rate of 6%. And we'll also assume a cap rate of 7%. So the way we would go ahead and arrive at the valuation for this property, all right, so we now have our net operating income. We want to go ahead and arrive at the valuation for this property. So what we'll do is we're going to take our net operating income and we're going to divide it by our cap rate. And that's going to bring us to the valuation of the property. All right, so taking the net operating income of $149,000 and assuming the cap rates in our local market is 5%, that's going to value the property at about $3 million or $2.9 million. All right, so we'll go ahead and drag that down. So assuming a cap rate of 5%, that's going to value the property at $2.9 million. Assuming a cap rate of 6%, that's going to value the property at $2.4 million. And assuming a cap rate of 7%, that's going to value the property at $2.1 million. All right, so that's how we can use the NOI to arrive at the actual valuation for the property. Now, another thing with having the NOI is that once we've gotten the property's NOI, we can go ahead and subtract our debt service. And once we subtract our debt service, that's going to bring us to our net income. All right, so hypothetically speaking, let's say this property has a debt service in the amount of $70,000 for the entire year. All right, so we'll go ahead and plug that number in there. Now, of course, this is going to be the debt service. And when I say debt service, we mean the mortgage on the property, right? So we've purchased this property, we financed it with the mortgage, so we do have to service the debt. So what we'll do next is we're going to go ahead and arrive at our net income. So in order for us to get to our net income, we're going to take our net operating income and we're going to subtract our debt service. And that's essentially going to bring us to our property's net income. All right, so that's going to be how you calculate the property's net income. Now, another common term that you might have heard if you've been in the industry long enough, or if you've, worked with some lenders in the past, you hear another term that we call the debt service coverage ratio. All right, so the debt service coverage ratio is going to be something that lenders would typically pay attention to. As investors, it's also something you want to pay attention to so you can make sure that you qualify for the actual loan. Now that we have our net operating income, all right, along with the debt service amount, we can go ahead and calculate our debt service coverage ratio. So we'll go ahead and calculate the debt service coverage ratio. In order to do so, we're going to go ahead and take our net operating income and we're going to divide it by the debt service amount. And that's going to bring us to our debt service coverage ratio. Now, in this scenario, the debt service coverage ratio for this property is going to be 2.13. And what that essentially means is that for every dollar of debt service there is, the property makes $2.13. Now, generally speaking, the higher the debt service coverage ratio is, the less riskier the loan is. The lower the debt service coverage ratio is, the more riskier the loan is. And that's from a lender's perspective. Generally speaking, the debt service coverage ratios you see in the market, depending on the interest rates and depending on where the market is at, most lenders are going to want to be above a 1.1 debt service coverage ratio. All right, so there you have it. That wraps up today's video on how to calculate the net operating income along with your cap rates to arrive at valuation and also calculating your debt service coverage ratio. If you found this information useful, I'm going to have a link in the description, and that's going to be a link to my PDF guide that gives you a little more information on the types of commercial real estate lenders.